Welcome to this explainer. Look, if you're managing significant wealth right now, you already know that filtering out the mainstream financial noise is absolutely crucial to protecting your assets. So today, we're breaking down a really fascinating and frankly critical special service newsletter from the Macro Butler. It's titled The Great War Inflation Tax. We're going to look right past those cheerful media headlines to understand the deep, historical relationship between geopolitical conflict, massive government deficits, and what the data strongly suggests is a looming second wave of inflation.
Get a load of this quote from the source material. The Fed didn't miss the inflation bus, it was busy driving it. I mean, wow. It's a bold statement, but it perfectly captures the essence of what we're about to review. Today, we are going to completely dismantle this widely accepted soft landing narrative. And we aren't going to use overly complex financial modeling to do it. Nope, we're relying on hard data and elementary school arithmetic to see what is really happening beneath the surface of the global economy.
Okay, let's dive into this. Here's our roadmap for today. First, the official inflation illusion. Second, markets price the reality. Third, war and price instability. Fourth, history's tragicomic script. And finally, preserving your wealth.
Kicking things off with Section 1, the official inflation illusion.
You know the mainstream narrative, right? It suggests the inflation battle is pretty much won, just a relic of the post-lockdown era. But the source data paints a very, very different picture. We are actually entering Act 2 of Inflation Wave 2, even as the market is basically acting like the concert is over and it's time to head home. US CPI year-over-year headline numbers might look totally manageable to Wall Street at a quick glance, but look at the underlying drivers. Energy, for example, is quietly accelerating. It's actually the biggest annual jump in energy since August of 2022. The newsletter points out that fertilizer shortages and energy shocks, well, they take time to work their way through the supply chain. They are just now finally leaking into the data, which means these temporary price increases might be anything but.
And it's wild how certain metrics are interpreted by policymakers right now. Take owner's equivalent rent, or OER. It's holding steady at 3.3%. The report literally calls this a zombie metric. Why? Because it's being treated like a massive victory lap simply because it stopped accelerating. But here's the thing. Holding steady at an elevated level still means it's continuously draining household purchasing power month after month. It's like a slow leak in a tire.
And then, oh boy, we have supercore CPI. That's core services excluding housing, which was famously championed as the Federal Reserve's absolute favorite metric for gauging true underlying inflation. While supercore CPI just re-accelerated to a brisk 3.67%. We haven't seen a pace like that since late 2021. The data is practically screaming that the brief period of cooling wasn't the end of inflation at all. It was just a transitory smoke break between waves.
Moving right along to Section 2, markets price the reality.
So, while official press releases and media soundbites are just full of dovish cheerleading, reality is playing out a lot differently when we look at actual financial assets. Money talks, right? And right now, it is telling a very sobering story. The broad expectation out there has been a swift return to aggressive rate cuts. But the reality creeping into the data? It looks a whole lot more like a stagflation environment. Slower growth paired with really sticky prices.
Just look at how Fed funds futures are reacting. Cutting rates straight into an inflationary boom has cost central banks some serious credibility. Wall Street has stopped whispering and started pricing in the hard truth. They are now literally pricing a 69% probability of a rate hike by October 2026. The market is finally waking up and bracing for tightening, not loosening.
We're also seeing this massive realization reflected in the US dollar. The dollar has been flexing higher, but the newsletter makes a really crucial distinction here. It isn't rallying on pure economic strength. Nope. It's rallying on the slow, collective realization that the aggressive rate cut narrative was just an illusion, one that has proven to be a very costly comedy routine for anyone heavily holding traditional fixed income portfolios.
And then there's gold. As financial assets wobbled recently, gold actually retested its earlier lows. The source report calls this a massive collective market memory lapse. And honestly, it makes sense. Investors are abandoning the ultimate anti-fragile asset at the exact moment that rising geopolitical conflict, soaring sovereign debt, and total fiscal recklessness absolutely demand you hold it. Selling gold in this specific environment, that's a highly questionable approach to risk management.
Okay, Section 3, War and Price Instability.
War is basically the oldest enemy of price stability. To really understand where inflation is heading next, we have to look at how global conflict dictates monetary policy. When nations go to war, budgets go right out the window. Tanks, missiles, supply lines, they're all financed with massive deficits and enthusiastic money printing. Central banks basically abandon restraint and turn into wartime financiers. And the inevitable result is the oldest economic magic trick in the book: a huge surge of newly printed currency frantically chasing a dwindling supply of goods.
And this isn't just a modern thing, it's practically a law of economic history. Let's trace it back. In the Roman Empire, continuous frontier wars led to aggressive currency debasement. They were literally stripping the silver out of their coins, which led to gradual fragmentation. The Byzantine Empire faced endless fiscal stress from fighting on multiple fronts. Fast forward to the Spanish Empire in the 16th century, they financed European wars through rampant inflation and repeated sovereign defaults, and they ultimately lost their global dominance. For seasoned investors, the takeaway couldn't be clearer. Military overspend and currency debasement consistently break empires every single time.
Bringing that macro-historical lesson a bit closer to home, check out CPI inflation during 6 major U.S. wars from 1850 all the way to 2022. From the Civil War, right up to the massive fiscal expansions we saw during COVID-19, Washington continually rediscovers the exact same truth. Printing money is always politically easier than raising taxes on the population. It's a remarkably consistent pattern.
Which brings us to Section 4, History's Tragicomic Script. So what actually happens to a society when inflation just runs hot for too long? It's way deeper than just paying more for groceries. It's about the destruction of the invisible foundation of a functioning economy: public trust. History follows a repetitive, almost inescapable script across centuries. Wars weaken a nation's finances. To cover the gap, the printing presses spin up. This unleashes inflation, which slowly but surely vaporizes the purchasing power of the middle class. And when trust in the currency breaks, citizens get angry and they start seeking out radical political solutions.
Let's look at a few extreme historical cases detailed in the source material. In revolutionary France, surging bread inflation quite literally introduced citizens to the guillotine. In Weimar Germany, astronomical printing meant people needed wheelbarrows full of cash just to buy groceries, entirely wiping out the middle class. In Russia during World War I, inflation was the true catalyst that ended the Romanov Empire. And more recently, Zimbabwe combined military adventures with agricultural collapse to create absolutely absurd hyperinflation. The underlying truth here is impartial and totally sobering. Fiat currencies can and do collapse much faster than any government's propaganda department can print reassuring speeches.
Finally, Section 5, Preserving Your Wealth.
So what's the actual actionable takeaway here? Well, it's time to step away from the spreadsheet hopium being sold by mainstream analysts and get back to basic elementary school arithmetic. Here is the math that the Source newsletter lays out. For the U.S. to actually hit that miraculous 2% inflation target, month-over-month prints from here on out would need to run below 0%. Statistically, given the current geopolitical conflicts and supply chain constraints, that is practically impossible. If month-over-month CPI continues at a far more realistic 0.2% or higher, we're looking at an annualized rate landing somewhere between 4.9% and 7.1%. The math absolutely prevents a return to 2% right now. Your wealth preservation strategy absolutely must account for sustained, sticky price increases.
Navigating this kind of historical macroeconomic chaos, that requires seasoned expertise. You can't just rely on the standard 60-40 portfolio playbook anymore. The source of today's deep dive, the Macro Butler, specializes in exactly this kind of wealth preservation strategy, focusing on anti-fragile assets perfectly tailored for these specific market conditions. We highly encourage you to reach out for professional macro guidance. You can email them directly at info@themacrobutler.com or just visit their website at themacrobutler.com.
I want to leave you with one final provocative thought to chew on today. Look really closely at your current risk management strategy. Is your portfolio truly prepared for the hard mathematical reality of inflation wave 2? Or are you, like so many others out there, still trading on the comforting illusions of wave 1? It's a critical question, and how you answer it might literally determine the future of your wealth. Reach out to the Macro Butler to make sure you're on the right side of financial history. Thanks so much for joining me for this explainer, and keep learning.